Hey everyone, and welcome back to another episode of Data Driven Value, where we show you the tools and we teach you the skills to help you take your financial freedom into your own hands. So today I'm going to cover a topic. We're going to look at how to build positions kind of from a more risk-adjusted perspective, rather than just the traditional idea that you just have to put all your money into the market at once, and that essentially time in the market beats timing the market. That being said, there is some truth to that. But there is also a lot of risk. Kind of, if you're a blind investor and you don't really follow the markets, you might not be aware of kind of some external risks or inherent risks within kind of the macroeconomic situation, and you might end up actually accidentally kind of putting that lump sum in at an inopportunistic time. If you're doing that near the highs of the market and then you go into a sustained downtrend, again, we talk about wealth preservation first and then wealth growth second. So again, we need to preserve our capital first. If we take high risk trades or investments and they go down a lot, it's going to be hard. We're going to have to wait for those to kind of climb out of the negative back into the green. It's going to test your patience, as well as it's just not going to allow you to take advantage of the dips. So my theory is that essentially we just look to kind of buy at opportunistic times. So after large retracements, we look to buy, and then we just position ourselves for those next legs up. I've talked previously a little bit about how to structure your portfolio in terms of risk-adjusted portfolio structuring. So today, it's just going to be a little bit more about kind of how we look at entering positions, a few different strategies that you might look at that might suit yourself as an investor, as well as looking at kind of similar strategies for exiting the market as well. So without further ado, we'll get into it. So right here, we just have this document here. I will have it linked in the description as well for you to reference, along with all my other educational resources, all available in that Google Drive for you to reference whenever you need. So dollar cost averaging, or DCA. So if you hear me say DCA, that's probably what I'm going to refer to it from now on. But just know I'm talking about dollar cost averaging. So various strategies to build positions over an extended period of time. We see here dollar cost averaging, or DCA, is an investment strategy where an investor consistently invests a fixed amount or excess capital into a particular asset, such as stocks, ETFs, or crypto, at regular intervals, regardless of the asset's price. This approach spreads out the purchase price over time, reducing the impact of market volatility. We see here, so this is the purpose of dollar cost averaging, essentially reduce that impact of market volatility. Since investments are made at different price points, this strategy helps avoid making a large purchase at a high price. That's what I talked about. You don't want to lump sum into resistance. That's really going to hurt if the market does reverse and you get caught on the back end of a really big sustained downtrend. So yeah, really just reduce that impact of volatility, minimize the emotion in investing. So you hear me talk about all the time about managing our emotions, because those are essentially what's going to cause us to make bad decisions regarding our investments. You don't want to invest based on emotion. Emotion is what's going to tell you to buy when things are high, and it's what's going to tell you to sell after things have already dumped. When alternatively, we really kind of want to be doing the opposite, especially as long as we're investing in assets that we believe in on the long term. Then buying it after the substantial retracements makes sense, and then taking profits during the times of euphoria, that makes sense as well. So definitely, it's all going to depend on your own strategy. Some people just buy and hold forever, and that's fine if you want to do that. But other people, they like to take profits. Maybe you have lifestyle expenses. Maybe you want to buy, that new toy or that new car, or you want to go on the trip, or so you really just have to come up with your own plan, your own strategy. But again, there's no problem with taking profits. Just because someone else is going to hold their Bitcoin until they die to pass it on to their family doesn't mean you have to. Again, your goals and your strategies are no one else's but your own. So just follow those and then make a plan that suits you best. We see here it also lowers the risk of poor market timing. So again, that kind of ties into this, preventing that impulsive decision, removing the emotion, lower that risk of poor timing, and encourage consistent investing. So consistency with your investing strategy is going to be really important going forward. Whether you're just doing a DCA strategy, whether you're looking at it from a technical analysis side of things or a fundamental analysis side of things, you really need to maintain some sense of consistency. Otherwise, how can you build a system that works for you if you're not consistently using that system, back testing it, as well as learning and adapting it as time goes on? So really just encourage that consistency. That being said, there are a couple different ways we can approach DCAing. So obviously it's commonly used in long-term investing. So a lot of retirement accounts, index funds, or just accumulating wealth steadily while mitigating risks. I argue this is going to be a really good tool, especially for young people. The younger you can start doing this and the more money that you can put aside to this strategy, it's really going to pay off in the long run. And I'm going to show you later on kind of the potential that we saw with Bitcoin just in the last 5 years. So that's not even from kind of the days when Bitcoin was just dirt cheap, and it's just gone up crazy since then. So this is within the last 5 years, and you're going to be shocked at the kind of returns that we see just in 5 years, as well as kind of the potential for, if you're just buying and holding versus kind of a DCA in, DCA out type strategy. So moving on, here we see types of DCA strategies. So as I mentioned above, the traditional DCA strategy typically involves a scheduled and fixed buying amount. So however much you can afford to put aside at a certain interval. Maybe you're buying bi-weekly along with your paycheck. Maybe you buy a little bit every week. There's some people who even buy every day. Like, if you want to put $10 a day in or $5 a day into Bitcoin, there's nothing wrong with that. You can do that. Just maintain that strategy. Come up with what works best for you. I personally kind of like the weekly DCA strategy. That being said, there are more volatile days of the week where Bitcoin is trading. Generally, it's Monday or Tuesday is kind of the most volatile. It actually also tends to be the best time to DCA. So you really can look maybe like a weekly DCA or a bi-weekly DCA. I argue if you're looking at kind of a monthly DCA, you're kind of spreading that time frame out a little bit too much. A lot can happen in Bitcoin and crypto within a month. You might, by the time you actually get that money to DCA, then maybe the price is a lot higher than it was kind of earlier in the month. So I kind of argue, a weekly, bi-weekly is kind of that sweet spot. But there are people who DCA every single day. So nothing wrong. Just come up with what works for you. And then, yeah, so here we see traditional DCA, fixed amount, schedule basis. So for example, let's say you have $1,000 extra a month that you're able to invest. Essentially, you're just going to put $250 in per week on a scheduled day, regardless of that price. No emotion. You're just buying and you're just holding and waiting. It's best suited to long-term passive investors with a longer time horizon. So look at least 5+ years if you're looking at the traditional DCA. That is pretty much because, especially in crypto and kind of macro markets as well. So you look at these kind of 4-year liquidity cycles. So almost every 4 years, we go through a bit of a downturn in the stock market as well as kind of other markets. It's kind of coincides with this liquidity cycle. There is even a lot of speculation that Satoshi Nakamoto originally kind of programmed Bitcoin to really focus the halving events around these liquidity cycles, and the kind of market cycles do line up with these liquidity cycles. So just keep in mind, if you're doing a traditional DCA, look at 5+ year time horizon, because then you're at least getting beyond that 4-year cycle. If you're looking at a 2-year time horizon and you bought at the wrong time in a market cycle, you could actually just be buying that bear market downtrend. So really have that longer time horizon. And then kind of looking at the visualization of potential returns here. So if you were to invest, this is actually based on $100 per week, this graph here. So I just did this as an example here, but this is based on $100 per week. If you're to invest, let's see here. So back 5 years from January 1st, 2020 to January 1st, 2025, you would have invested $26,100 total. You would have accumulated 1.12 Bitcoin at an average price of $23,200 roughly. And then this is your current portfolio value. So look at that, $114,000. You initially invested $26,000. You're up 337%. You've got 1.12 Bitcoin, and look, your value of your portfolio has gone up like $85,000. So a really amazing trade here, and shows you that power that the DCA really can have over time. That being said, we'll get down into a little bit more here. So there is, I call it a random DCA. So again, this is as blind as it gets, no rhyme or reason. So for people who might not necessarily have constant access to extra funds, so let's say, you don't always have that extra $100 at the end of the week to be able to invest, but you still want exposure to the markets and you want to be able to pick up some of these assets, then there's nothing wrong with, just allocating your capital as you have it. So, maybe 1 month you have a couple extra $100 to put into the market, and maybe the next month you only have $50 to put into the next market, and maybe the month after that you have a few hundred more. So you never really know, and you shouldn't let that kind of deter you from investing. A lot of people think, oh, if I don't put in a lot of money, it's not going to be meaningful. But I'm kind of have just showed you that, if you did this, so think if you did this with $2,600, you're still sitting at over $11,000. Like, that's really good money. You could travel the world with that, do whatever you want. It allows you the freedom, but you can kind of see, even on the low end of the spectrum, if you're just putting a little bit of money into the market as time goes on, generally it's going to perform well and it's going to help you in the long run. Obviously, it is less structured, but an option, again, for if you don't have that regular access to capital. Focus, if you're in this situation here, focus on saving where you can and investing those savings. So look at the different things that you're buying, your monthly expenses. Look for places to cut out kind of excess costs, wasted costs, things you might not necessarily need. I've really kind of started to look at the stuff that I'm buying from a kind of an investment standpoint, almost like, am I better off to invest this money in the market, or am I better off to put this money into whatever it is I'm buying? Obviously you can't skimp on your cost of living expenses. But that being said, do you really need the new computer or the new iPhone? Maybe you can get away, one more year with your current setup. So really just look at that wasted cost, wasted capital. You don't need a new phone every year. You don't need the hottest new car. You don't need, so really focus on saving that money, and then you're going to free up capital to be able to invest it in one of these more consistent strategies that's going to benefit you even greater in the long term. So you can really see just being smart with our money, being conservative, and really focusing on investing as much as we can as soon as we can, especially as young people. There's so much power here. We'll move on. So kind of get away from the random DCA, because some people might be in this situation, but you're probably in more of a scheduled DCA situation. There is also a way to kind of look at a dynamic DCA. So this is a way to kind of amplify your you raise your buy levels as the price kind of drops lower. So we see here, similar to the traditional DCA, but as price drops to the lower levels, you increase the buy size. So maybe to start, you're buying $100 increments, and then price drops to a certain level and you start buying $200 a week, and then it drops to your level below that and you start buying $300 a week. So you can see as the price drops, you're increasing the buy size, and therefore you're actually lowering your cost basis more towards the current level than what your initial buys were. So you'll see here, there's multiple ways to choose how and where you'll structure your buys, and it's going to depend on your own personal risk tolerance, amount of capital available, as well as the tools you have available. So a risk level dynamic DCA. So this, we're going to utilize a risk metric tool. This is an Into the Cryptoverse tool. So you can get access to this with a premium account. That being said, I believe this is a free one as well. So this is a DCA, a dynamic DCA based on risk levels. So sorry, I do believe this is a free tool. So you can sign up for a free account, get access to this and a few other tools that are really good for helping you navigate the markets. But we see here, ideally, we utilize this dynamic approach, increase the buys at lower levels. So you see here, if we were to accumulate up to 0.4 risk level, we're going to invest $13,100. We've accumulated 0.7813 of a Bitcoin. Our average price is 16,000. So look at this average price, 16,766, compared to this average price of 23,000. So it really shows you that dynamic DCA gives you a lower cost basis. That being said, look at the amount invested. So the fact that you just buy regardless of the risk or the price has you deploying more capital in the scheduled DCA. Whereas down here, we only spent enough time in this risk band for you to have deployed $13,100. That being said, look at the returns. So the returns, 505% versus 337%, lower cost basis. So you can see how this, from a sheer, like a P&L terms, or just percent returns in gains, this kind of outperforms the other one. And kind of you can see here, this is the strategy simulated over time. So this is how it kind of gauges it. This is just a Bitcoin price overlaid on the risk metric up here. So you see when we get down to 0.4 risk, that's where we start buying. You're buying $100 a week. We drop down to 0.3 risk. You start putting in $200 a week. We drop down to 0.2 risk, and so on and so forth. And you can see how as price continues to drop down these risk levels, you increase your buying. But look how little time of the market cycle we've actually spent in this risk level. So really you were only buying from about here all the way to over here and over here. So it was pretty small buying opportunities. Whereas if you were just DCAing this whole time, sorry about that. If you were just DCAing this whole time, then yeah, you're still looking really good. Moving on. Yeah, so still looking really good, obviously, but there is value. Obviously, if you're DCAing here, you're doing well right now. So you can argue that the dynamic DCA, it does often outperform. But that being said, you do have to recognize the risk that you might not get all of your capital into the market before it kind of leaves those risk bands. So that's what I talk about here. Risk not able to deploy allocated capital before the price leaves those bands. Therefore, you're left with a cash position. I mean, I argue that having a cash position is not a bad thing. If you could have 13,000, let's say you start with $26,000 or 26,100 roughly, the same amount as the other portfolio. You initially deploy 13,100, acquire this much Bitcoin, and it's currently worth 80,000. Then you're still left with another $13,000 of cash to kind of deploy in the market as you see fit. So again, we see here the initial strategy only allocates 13,000 versus the standard DCA allocating 26,000. So assuming that you have that same kind of that same amount available to invest, so we just did it on $26,000 basis. We see here you can combine a couple strategies. So I'm going to talk about a technical dynamic accumulation. So similar to the dynamic DCA, it's not based on a schedule and it's not based on risk factors per se. It's more based on technical support levels as well, and kind of breaking them up into the low, medium, and high risk zone accumulation zones. And then we increase our buys when we get to the lower accumulation zones, ideally. That being said, you could just split your buys up across the three zones. That's fine too. It does require a more better understanding of technical analysis and execution when prices enter your zones, because you're going to have to manage those trades and you're kind of going to have to be the one that pulls the trigger. That being said, you can put limit orders in, and it's just going to prevent you from having to, having to kind of make that emotional choice at the time whether or not to buy. You just let the limit orders do what they're going to do. Either they trigger or they don't, and then we see what happens. But kind of breaking it down on an example basis. So we have 26,000 here total to invest as of January 1st, 2020. Let's say we want to split it into 10 trades. So I talk about not taking on too much risk at once. So you're looking at maybe allocating 10% at a time that you want to kind of deploy at certain levels. So the levels that I pulled, they're kind of just based. So this is obviously the start of the year. So we were flat going through here. We had this initial pump. We don't buy into the pumps, and then we wait for our retracement. So we wait for that Fibonacci retracement. That's where we enter right here. And then we wait, and then we see. So we're not entering here. You might get another entry right here. It wasn't quite a Fibonacci retracement, but a nice little bullish back test. So I didn't include this, but this was an additional entry opportunity here. But you can see, look where the RSI is super low. So the RSI right dirt cheap right here. RSI at its lows right around here. Again, when we come back to that Fibonacci level, so that's another one, RSI low, and we come back, Fibonacci retracement, RSI quite low, again here, and then we're looking here for that next kind of low here to get a little buying opportunity. But I'll show you, I'll flip back over here. So if you were to buy 10% of your initial capital per level, so you would be buying 0.4 Bitcoin at $6,400. You'd be buying 0.09 at 28,700, 0.063 at 41,000, 0.11 at 23,000, and 0.026 at 49,500. You have a total Bitcoin acquired of 0.7022535. Total invested $13,050. Your adjusted cost basis is $18,583. So you can see how your cost basis from a technical perspective is pretty similar to, it's a little bit more than the dynamic DCA based on risk, and it's a little bit less, it's still a lot more competitive than the traditional DCA. So you can kind of just compare the two strategies. But moving on, we do see here the current Bitcoin value is 68,610, giving you a Bitcoin P&L of 369%. It also leaves you with $13,050 of cash remaining. and that would bring your current portfolio value to 81,660. So really good considering you're starting at 26,000, or roughly, that's over a 3x. Very good. In 5 years, essentially, to get those kind of returns, you're far outperforming any stock market. So yeah, kind of just moving on. Which strategy is the correct one? I kind of argue that a combination of multiple strategies can be very effective. That being said, you're going to have your own risk tolerance and strategy. If you don't want to pay attention to markets and you just want to put a little bit of money in every week on a scheduled basis, as I said, there's nothing wrong with that. Just recognize the risks and kind of adopt a long enough time horizon. But I want to show you how you see in both the risk level based dynamic DCA and the technical analysis based dynamic DCA, we were only able to allocate half of our capital. So I'm looking at a combination of the two strategies, which is actually, I kind of do a combination of the three strategies. I'm a pretty big Bitcoin bull, so I do like to DCA on a scheduled basis every couple weeks. And then I also like to DCA based on risk levels. And furthermore, I DCA based on technical factors. So I really use the three strategies in combination. That being said, you can use 1, 2, 3, whichever you see fit, whichever works the best for your own strategy. Obviously, we don't fully allocate all our capital if we're doing a risk level based or a technical analysis based, just because we don't want that risk of the lump sum. We do see, for risk management purposes, to be able to take advantage of substantial dips, we do want cash available. And we see in both strategies, again, utilizing approximately 50% of the capital while still yielding great investment returns. So what happens when we combine the two strategies? That's what I want to look at. So it is important to note, depending on where we are in the cycle, it may change how you look at accumulating Bitcoin or other assets. You may have missed the opportunity from a risk level dynamic DCA perspective. So assuming this market cycle continues playing out on a traditional cycle theory, you've kind of missed that opportunity. I don't think we're going to go below 0.4 risk until we go back into a bear market. That being said, that might happen, and we'll just follow the charts as we kind of go. But that being said, kind of the opportunity for that risk level dynamic DCA really comes during the bear market, not during the bull market. So we've already left those risk levels. So I kind of argue, if you don't have any exposure, a scheduled DCA in combination with a technical analysis dynamic DCA is going to be a good option going forward. And then we're going to structure our portfolio to best suit this strategy. The goal, obviously, maintain exposure and take advantage of substantial retracements, as well as taking profits off the table as they come. So obviously, the dynamic DCA approach during bear markets or long consolidation periods, they're great accumulation opportunities. You don't have the risk of lump summing and getting caught on the wrong side. So let's just look here. If we take a look, if we were to compare the two strategies, so combining dynamic DCA and strategic technical buys, essentially, if you would have kind of done the same thing that we just broke down above, but combined the two strategies, you would have had a total invested of 26,150. You would have a total Bitcoin acquired of 1.48355, adjusted cost basis of 17,626, and a current Bitcoin value of 143,904 with a P&L of 550%. So you can see the combination strategy outperformed all the other ones. So definitely interesting. If you can adopt some sort of technical basis to your accumulation strategy, I think it does really help in the long term. We'll flip over here. We'll look at, again, I'll just show you this tool, and you're welcome to kind of come over to Into the Cryptoverse, sign up for a free account, mess around with some of the tools. But again, you can kind of come here and see, if you wanted to put in $200 a week, $300 a week, whatever you want, you can kind of just adjust it as you see fit. We will move on. We're going to look at exit strategies and profit taking, because buying our positions and getting in is just half of the kind of strategy there. So we're acquiring these assets when they're cheap. We've made our buys, and now what? We want to, some people want to buy and hold forever, as I mentioned. Some people want to fund their lifestyle. Figure out what your goals are, and then kind of, again, come up with that strategy. So we've built that good cost basis risk adjusted position. We need to look at the alternate side of the trade. Generally speaking, when I achieve 100 to 200% returns on an investment, I take my initial investment out, removing any risk from that trade. You can also use stop losses after achieving these returns to protect gains without exiting the position. Then after securing your initial investment, look at how you want to take profits further going forward. I recommend utilizing either a risk or technical factors to gauge your profit taking levels. I use a combination of the two. So I'll start taking some profits based on kind of risk levels, and then I hold a percentage that I will sell at certain technical factors that maybe tell me we're due for a reversal or a kind of an upcoming downtrend. So kind of utilizing the two together. Obviously, ensure you're exiting at key levels of resistance, maximizing potential. Keep an eye on price structure of the market and watch for macro trend reversal signals. That's going to be a sign for us to try and get out of our positions before we go into a sustained downtrend. So DCAing out based on risk levels, similar to DCAing in. Choose a respective risk level to start taking profits, and either on a set amount or dynamic increasing amount as price reaches higher risk levels, you take larger amounts off the table. So we'll flip over here. We're looking at our exit strategies for, this is another tool on Into the Cryptoverse. So just looking at Bitcoin, if we had 1.12 Bitcoin, so that's the DCA amount that we acquired. Let's say we're looking at a projected peak price of $150,000 per Bitcoin. You're looking at 100 if you're aggressive. So even aggressive, I consider this, as a crypto investor, this is more the moderate one here. So let's say you're taking profits at 0.65 risk and higher. By the time you get to 150K, you will have sold $135.7 thousand worth of Bitcoin. So if we flip back over here, we'll take a look, and then obviously I'll show you kind of the comparison between the two, but that's kind of our DCA out tool that we can use. And then looking at the buy and hold versus DCA out profits, obviously just buying and holding in Bitcoin lots of the time outperforms in the long term, but as I mentioned, different strategies, different goals, different expenses. Some people want to realize profits. It also lets you free up that capital to use for other investment opportunities. So really don't underestimate the power of having a solid cash position. And you should be looking to opportunistically replenish it as well as deploy it when the times come. So obviously makes sense to take profits. And again, utilizing risk levels can remove the emotion. So below, we're just comparing the amount of value left on the table when you buy and hold as opposed to DCAing out. So scheduled DCA, if you held it until $150,000 Bitcoin, you would have a P&L of plus 140,900. Your DCA out P&L is going to be 109,000 after you subtract your cost, and then you're looking outperforming the buy and hold by 29%, or buy and hold outperforms this by 29%. And then in our combined strategy, we see the buy and hold outperforms by 27.8%. So obviously, buy and hold can outperform if you hit your price targets. So that's a big thing. Nothing's guaranteed. We're not guaranteed to go to 150K Bitcoin. So by DCAing out, you really, you take a little bit of profits here and price goes up. You take a little bit more profits here. You take a little bit more profits here. You take a little bit more profits here. You end up with still a very nice return on your investment. You didn't quite get the maximum P&L, but you took way less risk. And you didn't risk missing your targets and round tripping your bags. So that's a big problem. People get caught up on specific price targets, and when they don't hit, they just hold and they wait. They think it's going to go there eventually. That happened last cycle. Everyone was waiting for 100K Bitcoin, and Bitcoin just bled from 70,000 back to 15,000. So if you got caught on the wrong side of that move, it really hurt. You don't want to be there. You want to make sure you're securing profits. And again, no strategy is going to fit every single person. You need to figure out what works best for you. But I do argue at least DCAing out or taking those profits as they come, not getting so fixated on one specific cost. And then just some closing notes. Obviously, you see how by adopting a set strategy based on time-based or technical factors, you can remove all that emotion. That prevents you from taking additional risk of the lump sum. And also is similar to DCAing in you can realize gains as time progresses, reduce your risk, free up that capital, and use it elsewhere. Don't ever feel bad if you take profits and prices keep going up. That's why we adopt a system like this, so that we're DCAing out. We maintain enough exposure where if the market keeps going up, we're happy, and we realize enough profits where we're happy with ourselves as investors. We've made money. Obviously, you don't want to round trip your bags. I've done it. It sucks. Everyone's probably going to do it at some point. But if we can reduce the risk of doing this, we're going to be more successful in the long run. Obviously, you don't want to be wishing that you DCA'd out after the fact. So just be conservative. But again, do what makes sense for your own strategy. No one ever went broke taking profits. And if you don't take them, the market eventually will. So really good notes to kind of keep in mind there. obviously, again, different strategies we can look at for kind of investing in this market. And then going forward, obviously, this document will be available to you. We'll continue looking at how to structure our portfolios, what kind of assets we're looking at, different strategies for buying and selling, and then kind of just, again, we're going to take it day by day. We're going to navigate these markets together, and we're going to successfully kind of build a plan and execute that plan as the time comes. So if you like the content, if you learned something new, please like, share, subscribe. Again, all of these documents will be available in the description, and I will see you guys in the next one. All right, bye.